emergency TV18, celebrating 15 years of leadership.
Now, for Managers segment, today we have Mahesh Patil, Co-Chief Investment Officer at Birla Sun Life AMC. Mahesh has a life of rich experience, in this financial services business. Thank you for joining us.
Thank you.
I'm going to start by asking you what you make of where we are in the markets. 8,800 come and gone, 8,900 within touching distance today. Are we running up too fast, do you think?
Yeah, I think, after this month has been a pretty stellar month where we had a lot of positive news coming in. We had a rate cut and also a stimulus in Europe. So I think that liquidity is what...
But both were known about. It isn't that both came as an absolute surprise.
Sure,
Maybe the timing on the rate cut front was a bit of a surprise, but we knew that we were moving towards a down cycle in rates. We knew that the ECB... sovereign bond buying has been discussed for the last 5 months with regards to the ECB now.
Right.
So would you say that these are not necessarily factors that justify the move up?
No, I wouldn't say that, but I think we've seen liquidity has been pretty strong, okay? That global liquidity, there was some concern in the latter part of in month of December where we saw some outflows. I think more importantly, I think the domestic liquidity into the equity markets has been pretty steady. So we have seen almost like 55,000 crores of monthly inflows into the equity market, into mutual fund industry. And that's actually providing a good support for the market. And I think more important, I think no one is willing to give it because I think the longer term picture, at least for India, looks pretty good. And even globally, I think if you look at India, looks the only economy which probably will grow, a large economy where the outlook like to improve in the next 2-3 years. So I think no one is going to pull the plug soon. And so I think the corrections also in this market won't be very large. And as earnings outlook changes, I think this quarter might still be a bit subdued in terms of earnings. But I think next year, I think things are looking, I think we should...
You mean FY16?
FY16, yeah, I think with rate cuts and some operating leverage kicking in, some of the companies' demand picking up, say in the consumer side, we should add some impact of the lower commodity prices. I think that should benefit. So you should be expecting around 17-18% earnings growth next year.
Yeah. Okay, Mahesh, then taking that into account that you're expecting 17-18% growth, we're not trading at 17 times or 18 times or 15 times. Currently, we're around that 18-19 times out. When exactly do we become quite expensive?
So I think currently, if I'm not mistaken, we on a 1 year rolling forward, we would be around 8% higher than long-term average, okay, which is around 15.5. And so we are in a scenario where outlook in earnings growth in the next 3 years would be better than what we had seen in the last 7 years, which has been in single digits. Right? We are getting in a scenario where rate cuts, would be there. You could see another 75 basis point kind of rate cut. So your cost of equity capital will go down. So that can justify even a higher valuation.
Okay.
And most importantly, liquidity conditions domestically, as I mentioned earlier, would also improve. We expect domestic money moving into equities will only increase because the ownership level is still very, very low. So given these factors, I think potential for re-rating, if earnings indeed comes in growth at around 17-18%, not for next year, but even for the next 2-3 years, then even valuation re-rating from these levels can't be ruled out because we've seen what happens when liquidity comes in. So I wouldn't really bet on valuations. I would really look at earnings growth, whether they come in line with expectation. If that happens, then I think markets should do fairly well even from these levels.
You've launched a new fund called the Manufacturing Fund. It seems to be an area you're taking a big bet on, but it's also an area that will likely show results only in 2 or 3 years from now, or maybe 4, if new projects is what you're betting on, in terms of portfolio allocation in that fund. Talk us through where you intend to, invest that money and what looks most promising to you in this manufacturing story.
Yeah, so on the manufacturing side, I think the key theme is that we believe that India, in terms of competitiveness, I think we've seen, especially against China, I think because of the labor wage inflation in China, also because of the currency appreciation in China vis-a-vis the rupee, India's competitiveness has increased. We have the resources, in terms of labor. I think India contributes almost 25% to the labor force annually. And now with the top-down focus by the government also to really revive the sector, I think it's time that the sector should do well over the next many years. And India's manufacturing share to GDP has stagnated around 15% for many years, for a decade or so. If you look at a large economy like China, manufacturing is around 35% of GDP. I think we have a vision, at least top-down, to take it up to 25% in the next 10 years. Even if you go midway, I think you will see the sector growing fast. But I think in the interim, what we are betting is that as demand picks up, India itself is a large domestic market. and where consumption and demographics would still increase. So capacity utilization in the existing sectors, whether be it auto, be it capital goods sector, or even the manufacturing, that itself will drive growth in the next few years. And I think greenfield capex would take some time. I think the government is trying to do reforms, trying to address issues on land acquisition, labor reforms, which might take time. But I think despite that, I think we have seen success in sectors like automobile, in pharma.
You're convinced by the turnaround in auto?
Yeah, I think so. I think initially what we thought after the election results was more the pent-up demand, where we saw volumes kicking up.
Now we've seen the excise duty benefit go away as well.
So now you might see a bit kind of a moderation in growth, I think. But as the consumer confidence, even rate cuts, so you'll see better money at the hand of the consumer. So I think you should see next year at least growth.
What do you like the most in auto?
So in auto, we like the four-wheelers. And in two-wheelers also, I think we've seen, but there's a competitive intensity is slightly much more fierce over there. And I think auto ancillary is a space where I think things are looking much better, because it's not a domestic market also, but a lot of Indian companies have been able to cater to the global demand and scale up pretty well over there.
Would commercial vehicles be part of your bet on both a revival in manufacturing within commercial vehicles itself and a revival in manufacturing in other areas that might lead to a pickup in freight?
Yeah, so I think that's another sector which we have seen. Commercial vehicles haven't really, we have not seen any meaningful pickup in volumes over there.
But so you're not so upbeat on commercial vehicles?
No, but I think this is the time to really look at it, right? So I think if you look at it in India, there are not many stocks. I think the leading player, which is a domestic as well as a global player. So one has to take a view also on the global front, really, how we are positioned. But I think we should see a revival in the commercial vehicles also, because cut in fuel prices would also increase the profitability.
That would make, and I know you're hesitant to talk about specific stocks, but that would make Tata Motors and Maruti amongst your top picks when you look at allocating, let's say money from this manufacturing NFO or manufacturing fund NFO, at least in the initial months. Would that be fair?
It depends again on that point in time what the valuations are. But I think across auto space, I think whether it is four-wheelers, cars, or commercial vehicles or two-wheelers, I think all should do fairly well. And especially companies, I think we like companies which have strong domestic market share, but also have ability to really cater to the global market, because that's where the scale and size can really grow much faster.
All right, then looking at the cement space, it's a proxy to the infra play, I believe. And in fact, if you just look at prices over the last year, Rod, you've been seeing every time there's an increase in prices, demand's not really following up on that front. And even earlier this month, if you see, prices have been increased. And now there is a tendency to start pulling prices back. What's going on there? What's your exposure with regard to the cement space? Do you think there's more to go?
So cement is a direct play on the domestic infrastructure play. So there, I think we have seen demand from the housing side being pretty strong. On the infra space, we haven't still see any meaningful pickup over there. But our sense is that we'll see now kick off on the roads. Already there's bidding for 40,000 crores worth of road projects. Which tendering would happen, and you should see work on that progressing. Even in other infra areas like the urban transportation or metro projects, they are going on pretty well. So that should, I think, demand should pick up slowly. We have seen demand in kind of 5-6% kind of a range. I think if a GDP growth, our expectation is that next year GDP growth can be around 6.3% or so. So looking at the multiplier effect, I think you should see cement volumes pick up slowly, and capacity utilization levels are still pretty low. So and we don't see any big capacity coming in cement again. As you know, gestation for a new plant to come in is now, the time cycles are much longer. So if demand picks up next year, then I think you should see the capacity utilization move up, and that should do pretty well. So even in the current environment also, a lot of the companies are still generating decent return on capital employed.
Mahesh, one final question from me with regard to the real estate market. Now, we've seen that from the time we have a new Prime Minister, things are looking good, the equity markets run along, but is that temptation to put some money into real estate stocks?
So real estate sector, we have seen that the stocks haven't really done so well for investors. I think real estate prices have moved up.
That's right.
Normally, real estate sector should do well at the later part of the cycle, because that's where you will see consumer surplus savings really coming up. and as even the commercial part of the real estate is also pretty subdued.
Right. So when's a good entry point for that?
So I think good entry point, normally you would look at the mid part of the cycle. See, we are at the bottom of the cycle just trying to pick up. So that's where initially you will play some of the consumer discretionary and the financials. And I think at the latter part of the cycle, as interest rate cuts have happened, but we haven't seen any meaningful fall in terms of mortgage rate. So if that happens, and as business activity picks up, as job creation happens, I think that should provide better growth for the real estate sector. But at the moment, we have not so too inclined on that space.
All right, we're going to head into a quick break. When we come back, we're going to talk to Mahesh about financials, IT, pharmaceuticals, lots of sectors yet to discuss. We'll be right back in a couple of minutes.
CNBC TV 18, celebrating 15 years of leadership.